Right now, Micron Technology is trading at $937.85 per share, surging more than 7.5% intraday from yesterday's closing price of $865.46. If you have been tracking the NASDAQ or checking your individual brokerage account today, July 21, 2026, you noticed this sudden upward shift immediately. While the broader semiconductor sector is enjoying a solid bounce, Micron is separating itself from the pack. The mainstream headline claims today's pop is just a typical relief rally after a brutal drop from its all-time high of $1,255 set back in late June. But the real story unfolding behind this ticker tells a completely different story. Bank of America just added Micron to its prestigious US 1 list, pushing their price target up to $1,550 per share, while Morgan Stanley is pointing out that memory supply shortages are actively worsening, with contract pricing expected to jump another 25% in the third quarter alone. When retail investors look at Micron, the dominant belief is that memory chips are a pure commodity, subject to ruthless boom and bust cycles. The common narrative suggests that every time memory prices spike, chip makers overbuild capacity, flood the market, and cause prices to collapse. That exact expectation led short sellers, including high-profile hedge funds, to build short positions as the stock pulled back from $1,255 down into the $840 range earlier this month. But the underlying reality is that high-bandwidth memory, specifically HBM3E and next-generation architecture powering artificial intelligence accelerators, has fundamentally broken the historical cycle. Micron's entire HBM production capacity is already fully sold out through the end of 2026, with demand outpacing available supply by 50 to 67%. When you check your Robinhood stock trading app or look up market trends on Fidelity Investments, you see a stock that is no longer behaving like a simple cyclical play. It is transformed into an indispensable hardware toll booth for AI infrastructure. Looking closely at recent trading action, Micron's daily price swings have been remarkable. The 30-day annualized volatility hit over 100% as institutional investors wrestled over valuation. Just a few sessions ago, the stock dipped near $848, causing panic among those managing self-investing accounts or relying on SoFi active investing platforms. Yet during that exact drawdown, institutional accumulation quietly stepped in. Morgan Stanley analyst Joseph Moore publicly described the recent weakness as a rare buying opportunity, emphasizing that server memory shortages in enterprise data centers are far more severe than Wall Street models currently reflect. UBS highlighted that Micron could potentially repurchase over 40% of its outstanding shares once current buyback restrictions expire in December 2026. This massive mismatch between short-term noise and long-term capital allocation is precisely why institutional trading volume spiked over 37 million shares in recent sessions. To understand why Micron's order book is locked solid, you have to look at how hyperscalers are spending capital across the technology ecosystem. Whether you follow NVIDIA stock, Apple stock, or Tesla stock, every single major technology leader is competing for high-performance compute capacity. An AI graphics processor is essentially useless without ultra-fast, high-capacity memory stacked right beside it. When enterprise customers build massive server clusters, memory represents a rapidly growing percentage of the total bill of materials. This is why when investors execute trades through an interactive brokers platform or review their Schwab Intelligent portfolios, they notice semiconductor weightings shifting heavily toward memory providers. The structural bottleneck in technology is no longer just raw logic processing, it is data throughput. Before we explore the underlying financial mechanics and historical performance, drop a comment below letting me know how many shares of Micron Technology you currently hold in your portfolio, or if you are waiting for a deeper pullback before opening a position. Looking under the hood, Micron operates primarily across four major business units: compute and networking, mobile, embedded, and storage. Historically, standard DRAM for personal computers and NAND flash memory for smartphones drove the bulk of cash flows. When consumer electronics demand softened, Micron suffered steep drawdowns. But today, the revenue mix has dramatically pivoted toward compute and networking, anchored by high-bandwidth memory and enterprise solid-state drives. In their most recent quarterly report, revenue reached staggering heights, up more than 300% year-over-year, driven by higher average selling prices and rich product margins on high-density data center memory modules. Despite this incredible momentum, Wall Street bears continue to argue that competition from South Korean giants Samsung and SK Hynix will erode Micron's pricing power. They point to massive semiconductor mega projects being funded overseas as a reason to stay cautious. However, this expectation ignores the technological yields and thermal efficiency Micron has achieved with its 1-beta DRAM process node. Micron's HBM3E solutions consume roughly 30% less power than competing offerings, a critical advantage for data center operators facing severe power constraints. Furthermore, analysts from Bank of America explicitly noted that alternative memory architectures or open-weight artificial intelligence models actually increase memory bandwidth requirements rather than reducing them. For investors managing an individual brokerage account or using online investing platforms like SoFi Investing, SoFi Stocks, or Fidelity Wealth Management, recognizing these subtle engineering advantages provides a massive edge over reading simple headline news. From a valuation perspective, Micron is trading at roughly 21 times trailing earnings and under 15 times forward projections, despite its historic growth trajectory. This compressed multiple reflects lingering macro uncertainty, elevated interest rates, and huge capital expenditure requirements. Clean room expansion, advanced packaging facilities in the United States, and extreme ultraviolet lithography equipment require tens of billions in upfront capital investment. Yet unlike previous build-out cycles where capital spending led to oversupply, current spending is strictly tied to long-term advanced supply agreements with key enterprise customers. When you use an intelligent portfolio or research investing sites for long-term compounders, cash flow visibility is the single most critical metric. Micron's ability to lock in multi-year volume commitments with pricing escalators secures its operating margin profile against unexpected downturns. The tug-of-war between retail sentiment and institutional flows has been fascinating to observe across major platforms. On Robinhood app, Robinhood Investments, and SoFi trading platform channels, retail traders frequently jump in and out based on short-term technical chart patterns, often getting shaken out during 10% single-day pullbacks. Meanwhile, institutional desks using Interactive Brokers stock trading tools and Fidelity trading platform features have been accumulating shares on dips near key moving averages. The 50-day and 200-day moving averages have served as major inflection zones separating momentum traders from long-term value investors. Understanding these mechanical market dynamics helps explain why a stock can swing violently while its operational fundamentals remain completely unchanged. When evaluating where to park long-term capital, investors compare different asset classes and accounts across platforms like Fidelity IRAs, Fidelity Mutual Funds, and Fidelity ETFs. Some prefer self-directed options such as Interactive Brokers fee structures, Interactive Brokers account tools, or Robinhood fractional shares, while others opt for automated solutions like SoFi Robo-Advisor, Robinhood Cash Management, or Robinhood Crypto integrations. Regardless of whether you prefer active self-investing or passive online investment strategies, the core principle remains identical. Position yourself where structural demand exceeds supply. For those seeking investment help or comparing options on self-investing portals, understanding that Micron's pricing power is backed by physical supply constraints is essential for long-term allocation decisions. Looking ahead into the second half of 2026 and beyond, several distinct catalysts stand ready to drive Micron's trajectory. First is the commercial sampling and volume production of HBM4 memory, which transitions from standard silicon interposers to custom base dies built on advanced logic nodes. This custom fabrication creates sticky customer relationships, making it nearly impossible for clients to swap suppliers once a design is locked in. Second is the potential lifting of share buyback restrictions in December 2026, which could allow management to deploy billions in free cash flow directly into share repurchases, driving earnings per share significantly higher. Third is the expansion of AI capabilities into edge devices, including smartphones and personal computers, which will require significantly higher baseline DRAM capacities per device. Whether you utilize Fidelity mobile app features, SoFi active investing options, or broader Invest Online tools, watching these three catalysts unfold will provide clear guidance on whether Micron can reach analysts' ambitious price targets of $1,550 to $1,750 per share. To summarize the central thesis, market expectations continue to view Micron through the lens of historical memory cycles, anticipating an imminent collapse in pricing power and overcapacity. The reality, however, is that high bandwidth memory has fundamentally transformed the structural economics